Bank of Canada has delivered another 50 basis point rate cut, taking the overnight rate to 3.25%. Here with more, Sam Chai, Vice President, Active Fixed Income Portfolio Management at TD Asset Management. Great to have you here for us on a day when the Bank of Canada makes another jumbo-sized cut.
Thanks for having me here.
So let's talk about the rationale here for the 50 basis points. What was the Bank of Canada seeing that they felt the need to go for a big cut again?
So there are three key pieces of data that look at. Firstly, starting with the inflation side of things. The latest inflation data is actually more on the stronger side. The core inflation in particular is one of the strongest we've seen in recent months. If you look at the 3-month average core inflation, it has moved up from 2.1% from the prior month to now 2.8%. So that is something that is more supportive of a smaller cut. But then if you look at the GDP data, which is something we know the Bank of Canada focus at least as much on, that is a material downside surprise. So for Q3, the GDP growth quarter over quarter is only 1%, a meaningful undershoot of where they expect. And for Q4, preliminary data is also indicating that we're not seeing much of a pickup as well. So that then, with the two pieces of data, start to shift the balance a bit more towards the 50. But then we got the 50 beeps basically cemented last week with the labor market data. The labor job gain number is not bad per se, but the size of the labor force increase has far outpaced that of the job creation, which resulted in unemployment rate actually spiking up meaningfully. And so we know that the Bank of Canada will not be able to overlook that. And on net, it's a downside surprise on the data front as a whole. When we also think about the Bank of Canada's reaction function, we know at 3.75%, it is still in the restrictive territory. So there's a good argument for them to, make a bigger jumbo cut to bring rates decisively closer to the neutral rate range.
So we got that jumbo cut today, 50 basis points, last rate decision of the year. It's interesting in the statement from Tiff Macklem, the governor, his opening statement, 5th consecutive decrease since June. And then he threw this out. We anticipate a more gradual approach to monetary policy if things go the way they think next year. But next year, there's a lot of wild cards. I want to start breaking some of them down. They started with government policy. Immigration targets obviously could play a role next year.
For sure. So the immigration is obviously connected with the potential growth forecast the Bank of Canada has. And with that policy in place, and like Governor Macklem has mentioned as well in the statement, that the projected potential growth will be lower as well. And given that, year to date, we have not really seen much of the growth pickup, despite, a very aggressive monetary policy easings. That is just giving, more evidence and more argument for them to continue to be on this easing path here. But obviously, with the policy rate now in the long-term neutral rate range, and we know that because Bank of Canada's forecasted long-term neutral rate range is from 2.25 to 3.25%. So we are at the upper end there. So they can be a bit more gradual going forward, but the path is clear, right? We would likely to continue to see Bank of Canada on this easing path, but the pace and the size will be more data dependent.
I noticed too when they talked about the fact that, as you say, monetary policy doesn't need to be restrictive anymore. They want to see growth pick up. This challenge that could present itself, and there's threats heading into 2025, of course, is tariffs from our largest trading partner. Let's talk about the possible impact of those. We don't know, right? It's a wild card, but there could be an impact, obviously, if they did occur, and what it could mean for the economy and rates.
For sure. I would first say that the market is not expecting the 25% tariff that's being proposed to actually be implemented. This seemed to be more of a negotiating tactic than actual policy, because if that actually get implemented, given U.S. being our largest trading partner, it will have a devastating effect on the U.S. economy, and we're looking probably the Canadian economy going pretty quickly going into recession. So I think the growth impact is very clear. If Canada retaliated with the tariff of our own, which seemed to be the likely case, if we do get that escalation, then this would more so be a stagflationary impact for the economy as well. It will put Bank of Canada in a tough spot. But on net, it would be weaker growth, and possibly we're going to see some more inflation from that sort of outcome. But this is not currently priced in. This is not a base case, but we should be aware that this is a pretty major left tail risk for the economic outlook there.
Given everything we're talking about, given what we've got from the Bank of Canada today, what is the fixed income market telling us about all this? I mean, as they look forward into 2025, what is the market telling us about expectations for rates and for inflation?
For sure. After the 50 beeps cut, and because Governor Macklem actually tilted the guidance to somewhat a bit more hawkish, we actually see the Canadian bond yield moving slightly up. And currently, January is priced in roughly 80% chance of a 25 beeps cut. That's followed by 2 additional cuts by the end of 2025, bringing terminal rate to roughly around 2.6%. And when we think about the Bank of Canada's long-term neutral rate forecast to be between 2.25 to 3.25%, that is sitting where roughly the middle of that range is right now.
So as we put this decision behind us and we put 2024 behind us, one big takeaway thought for 2025. What do we need to think about when we're thinking about the cost of money in this country and inflation? They seem pretty confident we're at 2 and we're going to pretty much stay at 2, give or take.
Yeah. So I think that the base case scenario continue to be that we are heading towards a softer landing in Canada. Personally, like my view on the growth outlook is somewhat less optimistic than Bank of Canada. Bank of Canada is forecasting somewhere more of a trend-like growth, near potential. I think just given the latest data as well, and I think possibly Bank of Canada could update their forecast as well in January meeting when they publish the next set of forecasts, is that we could continue to see some negative output gap in the economy in the coming quarters. Obviously, there are a few key factors we talk about, the U.S. policies. On the monetary policy side, we have to admit there has been very aggressive easing already done by Bank of Canada, right? Almost 200 beeps, from 5% to 3.25% in just 6 months. That is lifting a lot of restraint on the economy. At the same time, though, it is not in accommodative territory yet, so it's unclear how much incremental, positive support it will give to the economy. So that is to be seen. On the fiscal side, likely that we're going to see a bit more of the fiscal easing measure in first half and next year. We're going to have the sales tax holiday pretty soon. So I think that's positive. That's a positive risk on the economy side. But overall, base case, more of a soft landing. Bank of Canada continue to be on this easing pace going forward, with possibly a 25 beeps cut being now the base case, given that the governor had mentioned that basically Bank of Canada will evaluate the need for further policy rate cut going forward. So that's a hawkish tilt on forward guidance, and that really shows a bit less commitment on the pace and the sizing of the rate cut going forward. But again, the path is clear, and we all have the data guide us on what the path will be looking like.